All right, welcome back to Living in Asheville channel. It is 7 p.m. on, what is it? Tuesday, November 18th. Can you believe that it's already November? It's practically December. And I know it's been a while and I haven't been here for a while. It's just been conflict of our schedules with me and my husband. Somebody, some of you might know that we work together, so we work on our business together, which means that um it can be a juggle to juggle work and kids. And my husband's usually doing open houses on Wednesdays. That used to be my usual time here, but anyways, I really wanted to make time and come live to today and talk about what is going on with rates, with government shutdown, with proposed mortgage products that were floating around in the last a week or two. I know it's been crazy. I know it's just kind of been a roller coaster. And a lot of people expect, talk about or hear about rates and how it affects them when they're thinking about buying, selling, investing, moving. Maybe not everyone realize how government shutdown also affects them, whether on the buy or sell side, and of course on if you're an investor as well, or on the move side. So I'm not here alone today. I am here today with our lender partner, Sabrina West, with Guaranteed Rate. She is local to the area. You are local. You're native,
I'm a native.
not just local. I'm local, but you're native.
I'm a native back 150 years, I think. Something crazy.
So knows the area in and out. Been in the business for what? How many years?
25.
25
It's still
years.
gonna be 25 next year, but it's 25.
Yeah.
It's
I mean,
gonna still say
a lot.
25.
So you've seen a lot. You've been through a lot. You work with different kinds of clients, meaning buyers, sellers, of course, investors, people
Mhm.
buying primary homes, investment properties, all
Relocations,
locations,
self-employed. Yeah.
all kinds of stuff. So let's start, I think, with rates. Give us a quick rundown what's happening, where the rates are, and maybe if you have that information in front of you on different products, meaning primary residence versus
Yeah.
um,
So, you know, rates range, obviously. So the market in general, when most people Google rates, they're going to go, well, rates are sitting at 6%. Like if you go to bank rate, they're going to sometimes be like, well, we're at 5.875, but it has points associated with it.
mhm.
So the average rate right now is about 6.1, 6.2. It just depends. That's going to be for a primary residence. That's overall. They kind of look at different down payments. So they might be looking at an average of this is with 20% down. Does that make sense? I
Mhm.
get the question a lot of like, well, so and so has this rate of this. Well, what determines rate is, your credit score, your loan to value, what's your property type, what's your program type, how much reserves do you have in. So it's, a few years ago when they put in loan level pricing adjustments, those things adjust based upon all of those things. So it's very, very individual. It's not a one size fits all. But rates are coming down significantly. I mean, a year ago they were averaging at 7.375 on a primary residence.
Mhm.
We're down more than a point. So it's really good. That's unconventional. If you look at FHA and USDA, I mean, I did lock somebody today at 4.99. That was, that's a VA rate, that was on a 5-year arm. Most FHA, you're going to be looking around probably about 5.375 on average for FHA, VA, if you're doing a 30-year fixed. Um, What else? So your governments are all going to be around the same type of rate. You're going to be in those lower fives for the most part, but then conventional is going to be in the sixes. Second homes and investment properties are always still going to be a bit higher. That's because when inflation went up, they were trying to get affordable housing down. And the way they did that is they said, okay, investors and people who can afford to buy second homes can afford to pay higher rates to be able to help affordable housing. So those rates are still ranging anywhere from for us particular, because we're such we're the second largest lender in the country. We have a specialty product for second homes and investors, and we're ranging between 6.375 all the way up to about 7.375.
Okay.
I know it's a range.
Yeah. I just wanted to really make a quick note. If I want to make sure that everyone can hear and see us. If you can hear us, whoever's watching right now, could you please put it in the comments that I can hear you and I can see you? And of course, if anybody has any questions along the way, put them in the comments now or after we're done talking, chatting, and say hi and let us know where you are joining from. Maybe it's here in Western North Carolina, maybe it's a different part of town, maybe it's different town, maybe it's different county or state. Let us know in the comments. Say hi. But yeah, so whatever the rates are right now, when people Google the rates, and that's what I tell my clients too when they ask me, so what are the rates right now? I tell them, but there's always but. You still have to qualify for them. You still have to qualify for that rate. So it doesn't, just because the rate is this, just because the rates dropped to 2s and 3s 5 years ago, does not mean that everyone got those locked in, because not everyone qualified for them. So that's the difference. It's never a bad idea to periodically check your credit history and make sure that you don't have anything that's not supposed to be there. Make sure that you didn't forget about some credit cards that you forgot about and they sent you to collections.
All the things. Yep.
If somebody sends you to collections, that can ruin your credit history. By the way, I just remembered, quick story time. I have a friend who, I mean, that was like 15 years ago. She forgot to return a book to library and they sent her to collections. Can you imagine?
Getting your credit pulled and being like, yeah, you don't qualify.
That would be
that library book.
That would be the stupidest thing. I would be so mad if my library screwed my credit history. But anyways, keep going. Anybody has questions about the rates and what it takes to qualify for them? But also, not just it's not just credit score, credit history. They added few other things, right? To qualify.
So I call it the principles of 5, right? So credit score is always going to be a big factor, right? Credit score used to be if you were above 700, you were getting the top tier rate. Now it's if you're above 760. So credit score makes a huge difference. That tells us how you pay your bills, Then you have the ability, you have your debt to income. I mean, not debt to income, your loan to value. That means how much skin in the game are you putting in, right? So how much risk are you? Are you asking for 100% loan? Are you asking for, only 80% loan value? Those kinds of things. And then you have occupancy type, and property type. Occupancy type, first home, primary residence, second home, investor. Those have risk factors. People walk away from investment properties if they hit hard times before they walk away from a primary residence. The property type, you're going to have different ones: USDA versus FHA versus VA versus conventional versus what we call non-QM. That means it doesn't fit in one of those boxes that the government created for us to underwrite to. Those play a huge part in it. And, reserves are starting to play a big part in that. Like if you're an investor or a second home, we want to see, and I tell this to first time home buyers too. I'm like, tell me about your 401k. It makes your loan file look stronger because we know that if you hit hard times, you know what? They're not putting out all the money they have in the bank for down payment and closing costs, and then they don't have any living expenses. It actually strengthens your file. So, add in that 401k, those savings bonds that grandma gave you. Those things actually play a part in it.
If you're lucky and you have a grandma that gave you some
I don't, but I do
don't.
have a client who happens to have savings bonds right now.
Good for them. We came to this country with $300 in the pocket, so. All right. So, okay, I think, again, if anybody has questions specifically about rates, put them in the comments, but let's move on to government shutdown.
Okay.
And what does it do to buyers who are looking at specific loans? The process, what does that all look like right now?
So for like Fannie Mae and Freddie Mac conventional loans, it doesn't really affect you all that much. The only place is when we're verifying like your tax. So we do third-party verifications, like tax transcripts. Sometimes it can affect us, but it really didn't during the government shutdown. We were still closing FHA, VA. What it affected the most was USDA loans. And that's because it shuts down that money. And so that USDA loans got affected the most. FHA and VA did a little bit. Sometimes those lag times. And that's really because there's government verifications that we have to do through their system because it's a government-backed loan. Even though you got to remember, it's not their money. The lender's still lending the money, but there's verifications we have to verify through those things. So we're not like bound up like we used to be, but it depends. If you're going with different types of lenders, certain ones have deeper pockets than others. So you would find that certain brokers or lenders would have a harder time being able to close those loans because they didn't have access to it,
Okay.
But for the most part, I mean, we're coming out of it. I didn't notice anything except on one USDA loan.
Okay. So was it delayed or?
It was just delayed. It was a longer contract. They were pre-approved. As USDA before the shutdown, they had to wait until the government opened back up before we could actually close on that USDA.
Okay. All right. Well, that's good to know. So that's important. It's important for if something like this, I don't know, happens again in the future. It's important not just for the buyers, if you're on the buy side, but also if you are selling, because if you're getting an offer with a loan that's dependent on government being in working order at work, like we are, it may affect some of the timelines or some other things.
My biggest advice is if this ever happens again, or we hear a talk, lean on your lenders quicker. Like if you hear that and you know that you go back to your pre-approval or you're buying and you're selling your property and you've got to buy, you just want to make sure that you lean on your lender sooner and go, okay, what's our alternative if,
communicate earlier, right?
Yeah.
So Tracy is asking about USDA. I don't know I guess you jumped on a little later, but Sabrina, if you want to cover that again real quick.
Yeah. So USDA did get affected the most. And that's because the guarantee commitments were, delayed. But they're back in full motion at this point. But it depends on the lender, So it depends on the lender, Like I said, we had one that was kind of delayed because of the guarantee verification, but for the most part, USDA is the one that got affected the most. Okay. But we're coming out of that.
Okay.
And it depends on when it was approved. Were those funds already guaranteed before the shutdown, right? Those loans still closed. Ones that did it in the middle of it, those guaranteed funds were not approved. So that's where those delays were.
Mm-hmm. One thing, I think we let us know if you, Sabrina, answered your question. But I forgot to actually ask you about the rates, and where I know, we talked about facts, meaning
Mm-hmm.
you told us what the rates are for different products, what they depend on, how, to best qualify for the best rate.
Mm-hmm.
But let's, can you get out your crystal ball?
Okay.
And
Where is it?
what are your feelings? What are your thoughts? I know it's just a speculation,
Mm-hmm.
but for next year, where does it look like we might be going as far as the rates?
I mean, we've been trending down for the last year. It's a balance. We have more things at our fingertips and more emotional decisions based upon the amount of information that we receive as a community in general, which means the market's always going to be a little more volatile. I think that we will hit, high. I think for the first half of the year, we're maybe going to get down to those, high fives, low sixes, kind of where we're at. They're going to do it very slowly, I think, because every time we start to drop too fast, inflation, they're playing that teeter-totter with inflation.
Mm-hmm.
So I think that it's going to be a slow decrease over time. But the Fed chair will be replaced in May of 2026. So we'll see where that goes. Some suspect that we're going to, start to really drop during that time. But I think that high fives, maybe mid fives by the middle of next year, but I think it's going to stay there for at least the full year. Like, I don't think it's going to be like, we're back to the threes and this is what we're doing. It's going to be a slow decrease.
Mm-hmm. Mm-hmm.
It's a balancing game.
Tracy said that he has lost 2 tenants, Section 8, who bought homes using USDA loans. And another question, does USDA mainly for Section 8? I don't think so. USDA is just, I mean, it's the product, and Sabrina, correct me if I'm wrong, for those, it's created for those who really don't have cash on hand for much anything.
And it's to bring people outside of populated areas. So it's
right,
a rural property.
And that's their way to incentivize that, because they either get in a loan and get in and having pretty much no skin in the game, but only have specific areas to choose. There's a map you can actually look it up. You can in Google USDA map or whatever, and you can put any address and it'll tell you if it's in or outside of USDA map. So basically anything that's close to city limits or town will be off limits for those buyers.
I'll drop this.
Outside the more rural areas, but some of them are not that rural. I mean, I had clients who bought with USDA a few years ago in Fletcher, a townhome right across from Ingalls in Fletcher. So it's, I think
the thing is it's for the first time we came off, and you can speak to this, Elena. I think to be honest, them trying to control inflation really was to try to get affordable housing back there. But I think along with, we just have more properties out there, and sellers, they sit a little longer right now. So I think you have more, people that are going after these properties. I'm seeing more lower price properties available, and so of course, if they can get approved with USDA, it's finally in kind of their price range. Even though rates are high, there's still all these other loans that can be done to get people qualified. Affordable housing has been on the forefront of lending for the last 2 years.
Yeah. And I think, Tracy, the reason you lost 2 tenants because they got USDA loans is because the market shift. And I'm going to talk about it in a different video about what it looks like these days with this whole market shift. But in a nutshell, a lot more sellers, a lot less buyers. It creates
Mhm.
the market is going the other direction from where we were 4 or 5 years ago. And so that naturally supply and demand, there's a lot more supply, there's less demand, and the prices are coming down. A lot of sellers, especially the ones that have equity, they're
Yeah.
going down. I mean, there's price reductions, $100,000, $200,000 price reductions, and I'm not talking about $1 million homes or $2 million homes. There's some,
No.
nine, eight, $700,000 homes, even less, that had significant price reductions. So that's a great opportunity for buyers who been holding the breath the longest, so to speak, and now they can jump on this opportunity. And if they can qualify for a loan,
Yep.
the way to go.
Well,
And
and I think it's interesting because what's happening is we're seeing our appraisals come in over value of what the contract is. So that that right there shows you a little bit of a lag time that sellers are just more willing to negotiate. You know what I mean? They're not used to sitting on the market that long.
oh yeah,
They're
oh
like,
yeah.
can I be done with this?
I mean, you're speaking from experience.
Yep.
So many properties sitting and not just getting offers. They're not even getting showings.
Yeah.
Ask me how I know.
How do you know, Elena?
How do I know? This will be covered in a different video, but
Mhm.
because we do work with both buyers and sellers all day, every day, boots on the ground. I'm not speaking out of, some, I read an article and I'm just spitting it out back to you. This is like real life. This is
Yeah.
real life experience working with buyers and sellers all day, every day,
Mhm.
and investors. So, but anyways, rents are very weak for lower end. Well, rental market went down too.
Mhm.
Um, Housing market, homes for sale, super soft. Rental market is super soft too, because
Yeah.
a lot of these people, especially the ones who bought a property in the last year to 4 years, now they want to sell. And there's a ton of those people, believe it or
Yeah.
not. Now they want to sell. That was not enough time to gain any kind of equity, especially when the market is going in a different direction. They bought it at the height of the market. Now it's going in a different
Yep.
direction. They're trying to sell. They cannot sell. They physically cannot sell because they'll have to pay money to sell the house. They will not net anything. They will have to pay the money at the closing table. So they decide to go back, they're like, well, we can't sell. We're going to put it all up for rent. And now
But it doesn't that speak to like that panic? It's almost like when you see a stock drop, right? Like if you go to a financial advisor, they're like, go for the long game, right? And that's whenever you get with a real estate agent, you get with a lender, that somebody that understands the long game, who understands the market and 2 to 3 takes all of the data, looks at all of the things to kind of determine that. Because I think that's what people do is they panic when they think everything's dropping and then they sell at whenever they sell at the wrong time. I'm like, if you can hold on just a couple more years,
yeah,
like, will it come back up? Take your time. That's why we say it's just such an individual process
yeah.
financially. I think sometimes we can get too much into what we read and what we are seeing instead of just paying attention to how you're living and does it serve you,
Yeah. Yeah. Again, I'm gonna do another regular video, and I'm gonna cover what I'm seeing on my end, why people are selling. A lot of people are selling right now. And it just, yeah, some mistakes that people make when moving to the area and
Mhm.
buying properties. And those are not mistakes that a lot of people think. Those are not the ones that you might be thinking about. But anyways, you just have to stay tuned, subscribe if you want to, keep up. All right. Any questions about what we just talked about? And we talked about everything again, rates all over and where it's going. Um, Government shutdown. And now, if nobody has questions, I want to move on to what are we talking about? Oh, what is it? It's been 1 or 2 weeks that all those proposals were floating on the internet, and people were losing their minds with 50-year mortgage. With what's the other one? Is it mobile or portable mortgage?
I think it's a portable.
Portable, yeah.
And these things
Yeah.
have been around forever, just so you know.
All right, we'll share away.
The 50-year mortgage is a headline. It's a headline. Just because it comes out that they're going to do a 50-year mortgage doesn't mean that lenders are going to adopt it. They're going to look at their risk accessibility and determine if it's a product they want to pick up, right? Not all lenders will offer it. What people don't understand is the 40-year mortgage has been around since early 2000s.
Mm-hmm.
No offense, but if you're going 40, what's the difference of 50? To be honest, I think people get scared, but it's really a headline. Will it help people stretch out a term? Is it a product that you sell? It's kind of like it's no different than that, a risk of, I know people's biggest fears are like, oh, but they're going to be paying on a mortgage for 50 years. I think you have to understand, one, it's a headline. Two, 40-year mortgages have been around since the early 2000s, but not everybody uses them. It's very rare that you have to put somebody in one of those. And then three, the average person stays in a loan, the longest they ever stay in a loan, statistically, is 7 to 10 years.
Right.
People do not stay, and I'm not saying it doesn't happen. If there's anybody on here who's like, no, I've kept my mortgage for 25 years. I'm not saying it doesn't happen. It happens when you have a 3%. It happens when you have a 2%. You're more apt to go, you know what? I'm going to keep this property, but I'm going to move up into a different property. Hey, I'm going to do this. But for the most part, it's not, people don't stay in mortgages long. Right. They might stay in the same house, but it doesn't mean they stay in the same mortgage.
Mm-hmm.
Things.
So one of those ways to, I guess, or an option to make it just a little more affordable on monthly payments.
Yep.
For those who cannot do, the difference is really small. And it will be like for a lot of people, like $200-300 difference.
Yep.
For somebody to be like, that's nothing. Is it worth it to pay more? Interest rate. But for some people, I know we work with some of these first-time home buyers who are having down payment assistance, who are having to ask for seller-paid closing costs. For them, that's huge difference.
It is.
So the product, I guess, and just because let's say hypothetically it's going to be rolled out, right? It doesn't mean it's still going to be a choice, just like it is right now, right? 15, 30.
There's a 10, a 15, a 20, a 25, a 30, and a 40.
Mm-hmm.
And there's a 40-year interest only, a 30-year interest only.
Yeah.
Those products are still around, but the only people I usually do a 40-year mortgage for are typically investors. Because I work with a lot of investors. What they do is they'll set up on a 40-year mortgage. They'll do it interest only. They'll cash flow the property for 2 or 3 years, and then they're out of it, right? So it's a tool for, you know what I mean? They know that are they going to outpace appreciation? It depends. Those are usually the people, first-time homebuyers. I'm not saying that they don't. I have looked at a 40-year mortgage for a few people, but the guidelines get a little tougher on a 40-year or a 50, and it will get tougher on a 50-year because it's the box that they have to be in. You know what I mean? Do they have any reserves? Lending's not built to make people default or just, lenders are in the business to make money, right? But it doesn't mean that they're there just to go after those first-time home buyers. But it can make it easier. Those first-time home buyers will build equity much slower, right? But if their rents are here and a 40-year mortgage saves them money and gets them home ownership, that's where you've got to find that what's the best for them and their family and where they're at.
Now, what about portable mortgage? What is it, and what are your thoughts on that? for those who don't know?
Well, there's two different terms, right? So I was looking at this because I've heard people using portable mortgage, right? Which means, or are you talking about a portable mortgage, or are you talking about an assumable mortgage? There's two different things.
Well, I think the next proposal after 50 was what I saw on the internet was portable mortgage, meaning, and I was like, that's
It
what I
means
was.
you can sell your home and then take your mortgage with you to another
Right.
lender.
Yeah, I guess.
Yeah. Instead of paying off your current mortgage and starting over, you're kind of like taking it to the next property. Lending's still a business. And I say I'm being as transparent as possible. I've been doing this for 25 years. I think sometimes people forget lending is still a business. And it's like assumable mortgages, portable mortgages. You have what we call retail, right? Who people make money on the front end. And then you have that back end in lending. There's a lot of middlemen in lending. And then when you're talking about servicing, they're not going to do that for everyone, right? So it's kind of like, it's like going to your bank and saying, well, I can go and get a portfolio loan from my bank because I have $300,000 in the bank. Does that make sense? So I think it's going to be, servicers are not going to just always let people port. It's going to be, are they a client that has shown enough loyalty with particular servicers or banks or lenders to where they're going to put them in that product that they can do that? Does that make sense?
Yep.
I just don't think it's going to be some, I mean, I've been doing this for 25 years. Assumable loans have been around forever. I've done 2.
That was going to be my next question. How common are they? Because I've only seen one listing, which I don't read every listing that comes on the market. I don't read, the description. I only seen one or maybe 2 that the loan is assumable. And I've been in this for 9 years, a lot less than me, but still.
I got a lot of calls over the last year about that. They're like, hey, because they're trying to get traffic, right? So they're putting anything in there. They're like, hey, my people have this VA assumable loan, or they have this that's assumable. Should I be able to put it in there? I'm like, you know what? If it gets more people in the door, that helps them kind of look at it. I've pre-approved people, but how do I say this without like hurting the lending industry? The reality is they make it as difficult as possible to get approved, and it's such a long process. That's why I've only seen 2, and they've both been VA.
Okay. Do you have to be
a veteran to a veteran? Does that make sense?
Right. Okay, that was my next. Okay. All right. So
I know.
But basically, just next, might as well just work on your credit score and save some money for down payment and closing costs and all that kind of stuff.
It's kind of like what I call my hopes and dreams. I'm like, hey, let's have our first call. It's called your hopes and dreams call. We all want to explore everything, but it doesn't always mean you're going to fit in that box.
You know what? I just remembered we almost got a listing, and then we decided to not proceed with that seller. He had an assumable mortgage, but the house was in the 900s price range, so 950, like that. His balance was like 400. So you still had to bridge that gap and either have money down, like $500,000 down, or do another loan. I'm not sure.
Yeah, a lot of times they'll take out an equity loan second to be able to do them. Like I said, I mean, there's such a long process. I've seen 2, and it's not that I avoid them. I always try to do them, but you've got to get one lender to agree with the other lender, right? So it depends on who that one is with, right? And then what lender. Most of the time what happens is I usually send that buyer back to the seller's lender to see if they would get approved.
That's what I was going to say. Is probably best bet is to stay with the same lender so that they are kind of keeping the money in the same pot.
Yeah. Because that's the goal. They don't want to get rid of that out of their portfolio, especially if it's somebody that pays well.
Yeah.
And two, you're assuming these people want to assume a 2 and 3% interest rate. How do lenders make their money? How do servicers make their money on the interest? Their goal in the end is, it's not that they're trying to take advantage, but their goal is like, it's not usually in their best interest. It depends on
Right.
the property. It depends on the equity. There's so many factors that go into it.
Okay.
I'm just going to put on my screen, it depends.
Right. Right. It's like with everything, it depends.
It depends.
Everything is negotiable, and it depends.
It is.
Well, thank you so much. Appreciate all the wealth of knowledge and expertise and experience that you always bring into these calls. If anybody has any questions,
Ask away.
hi, Doug. All right, we're in business. Well, we're almost done, but thank you. If anybody has any questions, put them in the comments now. After we're done with the live stream, I'll be sure to direct them to Sabrina, or I'm going to put her contact information in the description of this video. If you have any questions, again, she's a local lender. She's native to the area. Very rare breed these days for this area. Wealth of knowledge and experience and expertise. Appreciate you always. And again, these are your facts, some of the predictions, some of the speculations and thoughts from industry leader.
I will give you one nugget, though, that I forgot to mention.
Okay.
ARMs are back on the rise. 7-year ARM.
7
year.
All right.
Ask your lender, aka me, about the 7-year ARM.
Yeah.
That'll save you quite a bit of money.
Yeah. And by then, you might even move out of your house, sell your house.
Statistically.
Statistically, yeah. We are opposite of statistics. We've been in our house since 2007 and do not plan on moving anywhere.
Look at you. Yeah. See, I wish. Nope. I move every 5 years.
Yeah. 5? I thought 2 or 3.
5.
Tracy, thank you. Thank you for joining.
Yes.
So this is the video for this week. I will catch you all next week. It's going to be the week of Thanksgiving. Wow, time flies. We're having all fun.
Turkey time.
Turkey time, exactly. So I hope everyone is having good, easing themselves into the holiday season. Do not go too crazy on spending, overspending, and overeating. Everything in moderation, people. And I will catch you on the next one. I'll put Sabrina's contact in the description of this video. Bye.
Thank you so much. Bye.